Hi everybody, welcome to tonight's lesson on how to locate support and resistance on any chart. This is Sami Abu Saad. I am Director of Education at T3 Live, and we are in the middle of a coaching session for the Strategic Day Trader Room members. We started this lesson last week. We talked about support and resistance, minor support, and the abbreviation for it is small m, capital S, and minor resistance, small m, capital R. In last week's video, I'll do a recap to this week, today, and we'll go ahead and talk about major support and major resistance. Those are the two types of support and resistance that exist on all charts. Okay. Before I start, I just want to say that whatever we discuss is for educational purposes only, not to be construed as a recommendation to buy or sell anything. That's a standard required disclaimer that I have to share with you. Okay, so just be sure that you understand that. And if you agree to it, then let's go ahead and continue. So we talked about, again, minor support and minor resistance. And we said that minor support doesn't mean it's weak, minor as in, like minor league, major league. It doesn't mean it's insignificant. Minor just is the name that it was given. And this support exists only in uptrends. Minor support only exists in uptrends. Minor resistance only exists in downtrends. So what is it, you might say? Well, here's what it is. In an uptrend, when the stock pivots, like over here, when it pivots, puts in a pivot high or a high pivot, that creates a bit of resistance. So when it overcomes that pivot high, that becomes support on a pullback. So what was resistance becomes support on a retest, on a pullback to that support area. So that is minor support. The premise or the reason why this area, why resistance becomes support, is because shorts that traders that shorted the stock here or the market, when the stock goes through their stop, they don't even know what the stop is. They don't cover, so they're trapped. And if you're trapped and you're keeping the stock and you're keeping the position, you're not exiting the position, and the stock keeps going against you. You're now, let's say, down 1,000, down 2, down 3, down 4, down 5. Why would you be doing that? Why would you allow your loss to get bigger and bigger without exiting? Well, there's only one reason why traders do that, and all novice traders do it. There's only one reason, and the reason is that they have injected themselves with hopium. They are hoping for the stock to come back down to break even so they can exit at break even and not take a loss. So guess what? When the stock comes back down to here, to where they shorted, they cover. Their covering pushes the stock higher, and it goes back up. But not only that. So that's the main reason why these pivot highs become support in an uptrend. What was resistance becomes support in an uptrend. Okay, that's the main reason. But there are other groups of traders that also look to get in that area. One of those groups is the bulls that were in it, and when the stock started to come in, they got shaken out. They panicked out of the stock, maybe. Perhaps they wanted to hold it to there. Their target was way up there, but they got shaken out. It happens to me, and I'm a professional trader. So, and then you get out of it, and it shoots up, and you say, "Darn it! I wish I didn't exit." But guess what? When the stock pulls back, it allows you to get back in it. It allows you to get your position back at the same price, or almost at the same price that you exited. Does that make sense? So these are called the sold out bulls, the bullish traders that got shaken out, basically. The sold out bulls look to get back in at the same area where they exited. That's another group. The third group are the professional traders that know about this area being a strong demand area, and they look to get in there because it's a great area for to buy. It's a great area to buy a stock that's uptrending. So those are the professional traders with which basically add fuel to the fire. That's what it does. You're adding fuel to the fire. And then another group of traders are the ones that are always the bargain hunters that are always looking to get to go long on a to go long a stock that is in an uptrend and that has but is has given them a pullback. Those are the value buyers, like the Warren Buffett of technical analysis, basically. That's what Warren Buffett does. But we're talking about charts here. Does that make sense? So you have at least four groups of traders that look to go long in that area, which makes this area an incredibly, an incredible area to go to look to for an entry there. And it's an area. It's not an exact amount. It's not an exact price. It's not like as soon as the stock touches the prior pivot high, that's when it bounces. No, it's in that area. So this is a good area to look for an entry. Now you might ask me, well, what kind of entry? Well, that's another topic for another lesson. So you have to know what type of entries you're looking for, but that is the right area to look for that entry. So in a downtrend, the opposite happens. A lot of people go long in a downtrend when the stock starts to move back up, but it's in a downtrend, so it continues lower. And now they're in pain. They're really suffering. They're down money. Why are they still in it? Because again, they're hoping that the stock goes back up so they can get out at break even. And they get out. And then when they get out, that means they're selling. They went long here, and then they exit their long position right here. The selling puts pressure on the stock to drop. It drops. Professional traders pile on. Does that make sense? And the cycle repeats and it continues lower. Same thing happens here. And that's minor resistance. That's called minor resistance. Okay. If we were to look at a chart, what was resistance becomes support on a pullback. Resistance here becomes support on a pullback. You might say, well, wait a second. That didn't pull back all the way to the prior pivot high. So that can't be at minor support here. That can be at minor support. And the answer is no, it was at minor support. The thing that routinely happens is, let's say somebody shorted here, okay? And then the stock went against them. And let's say initially here they're down 1,000, down 2, down 3, down 5, down 8, right? They're in a lot of pain. When the stock comes in, now they're down 4, down 3, down 2, down $300, down $200. They say, what the heck, I'm out of here. I don't care about $300. So a lot of them start covering as the stock approaches their break-even point. They don't wait for it to get exactly to their break-even point. Does that make sense? And that's why you often find strong stocks turning around, going back up without really reaching the prior pivot high. Okay? So that does happen. Let me see. Did I accidentally move the slides a little bit or? Huh. Okay. Whatever. I think. Let me see. 1 second. I might have. Just trying to reposition it, recenter it. Okay. I think this is good. I see that it's messed up a little bit, but it's all right. Okay, there it is, almost. Okay. Anyways, what was support doesn't have to be a pivot. It can also be a base. If it's a base, that makes it so much more, so it makes it stronger. If it's a base, it makes it stronger. And I skipped this slide. I guess I didn't go over it. So there's the pivot high, which was resistance, and the stock went up there and based at it. That's a base at minor support. Okay. This is a base breakdown, and that's the first sell setup after a base breakdown. Did you know that the strongest sell setup that you can take is the sell setup that forms after a base breakdown. Did you know that? Did you know that the best, when I say the best, I mean the highest odds. The buy setup with the highest odds is the buy setup that forms, that comes after a base breakout. Why is that? Because there's a lot of people, usually when a stock bases and breaks out, there's a lot of people that want that stock that missed the breakout, a lot of people that shorted it thinking it was the top. So when it pulls back and you have all the support to the left, oh my God, that's a very, very high odds play. It's the highest odds play, highest odds pullback that you can ever have. So this is a very high odds play, by the way. This sell set up here, you short it under the prior bar's low, stop above it. Okay? It's one of my favorite buy and sell setups ever. Same here, except this support was from the prior day. See how this was yesterday, the previous day? So we like support to be, or resistance in this case, to be from the same day. Because a lot of the traders that bought yesterday are long gone. It's still relevant, as some of them were probably still in it, but it's better when it's from the same day. So we talked about that last week. Are there any questions, guys? Are there any questions? Again, I apologize, the slides are not centered. Okay, maybe now, we'll see. Okay, if there are no questions, so now we're going to talk about major support and major resistance. Okay, we're going to talk about major support, major resistance, which mainly exist in sideways trends. The concept of major support and major resistance forms the foundation for numerous highly accurate trading tactics. Its main purpose is to help the T3 trader exploit the opportunities that exist in sideways trading patterns. Because the market spends a good portion of its time trapped in neutral sideways trading patterns, it is imperative that the T3T knows how to adeptly handle them with the following concept. I'm not going to read this, but let's continue. So major support is a price level or area at which demand for a stock overwhelms existing supply. In other words, it's an area at which the buying, which was light, begins to overwhelm the selling. This offers a unique buying opportunity. The key thing to remember is that major support can be defined by the following. Current pivot low, revisits prior low. Okay? Every low from which a strong rally ensued has contained within it contained within it a certain degree of positive memory. This is what creates something close to a self-fulfilling prophecy, which is another way of saying it creates a very high odds long scenario. So the first and second areas were self-fulfilling buy points due to the previous low uncircled having produced a strong rally back to the $24 area. This rally rewarded traders who will always look to repeat their actions on the next go around. Okay, so that's major support. So major support exists not because traders were hurt and they're looking to cover at the prior resistance where they went short. Major support exists because traders that bought the prior low were rewarded. Rewarded traders always look to repeat their actions. Does that make sense? So major support exists due to a self-fulfilling prophecy. Their buying propels the stock higher. Okay? That's major support due to a positive memory being rewarded. Rewarded traders look to repeat their action, and that's why major support exists. Major support exists in sideways trends, in uptrends, in downtrends also, but mostly in sideways trends. Major resistance is a price level or area at which supply for a stock overwhelms the existing demand. In other words, it's an area at which the selling, which was light, begins to overwhelm the buying. This offers a unique shorting opportunity. The key thing to remember is that major resistance can be defined by the following. Current high revisits a prior high. Every high from which a strong decline ensued has contained within it a certain degree of negative memory. This is what creates something close to a self-fulfilling prophecy, which is another way of saying it creates a very high odds short scenario. Does that make sense? The first and second circles were self-fulfilling sell points due to the previous high uncircled, producing a strong decline back to the $20 area. The decline hurt traders who will look to get out once they are redeemed. But that's not the only reason. There's another group of traders that also look to take advantage at prior tops and bottoms, and it's called technicians. It's called day traders, professional traders also. They recognize that and they pile on. Their selling or their shorting is the same as selling the stock, adds fuel to the fire and makes the stock drop. So when you have a T3 buy setup at major support, it actually becomes a more compelling buy setup. It gets 10 extra points on the grading or the rating system that we teach. It gets 10 extra points. Positive memory, rewarded traders look to repeat their actions, which produces again the double bottom. If you have a spike in volume, if you have a narrow range bar, and if you have this is called a COG bar or changing the guard bar, those are all additional amplifiers. So the major support is an amplifier, the spike in volume is an amplifier, the changing the guard is an amplifier, and the narrow range bar is an amplifier. That's 4 additional amplifiers or 40 extra points. So this would be a 50 point buy setup, a 50 point buy setup. This would be a 50 point sell setup. Okay, the T3 sell setup at major resistance. Okay, negative memory, traders who got hurt get redeemed when they exit, it forces prices to come in. So it becomes a self-fulfilling prophecy. Now, this is not exactly how it looks on a real chart. This is how it looks on a real chart. It's a little more sloppy. So now keep in mind also that the first, you need 2 pivots, 2 prior highs. So you need already a double top before you can look to short. And then every other time after that you can short. But you need 2 reference points. There are exceptions, and I'll talk about that in a few minutes, but you need 2 prior pivot highs. Here you need 2 prior pivot lows before, no, the first one is not really a pivot. Here's 1, here's 2, and then every other time you can actually buy. Every other time. Does that make sense? 1 reference point is enough under certain situations, and I'll talk about it in a little bit. Okay, so this is even cleaner. Notice again that the first pivot high you don't do. These are the first 2. Actually, you could have done this one and then every other one after that. So we need 2 reference points. Why is that? So here's the first one, second one, don't do, third one, fourth, fifth, sixth, seventh, eighth, every other one after that you can do. Why is that? Does anybody know why? We need 2, at least 2 reference points before we can call that a major resistance area. Again, 1 pivot, 1 reference point is enough if the prior low was an area where the stock went climactic. A climactic buy setup formed in that area, then 1 pivot would be enough. Or 1 prior reference point is enough if the rally that was produced was so significant that it actually broke the trend line. So if we were to draw a trend line, that clearly broke it. In fact, the stock went from 10 to 22, I think, or to $20. So that's 100% rally. It doubled in price. So when the stock comes back down, there's a lot of eyes on it, basically, because that's an area where the stock doubled in price. Who wouldn't want to double their money? Does that make sense? So 1 reference point is enough rather than 2, because if the first reference point was an area where the stock went climactic, what does that mean to go climactic? When you get that waterfall, that big drop, the stock goes vertical, runs out of demand, selling, runs out of supply, and pops. If it retests that area, that often is enough, 1 reference point. Another time when 1 reference point is enough is when that prior rally was so huge that it really jumps out at you when you look at it. It's so big that it broke the trend line all in one fell swoop. Then the retest is you only need one reference point. Another time, so A, B, C would be if the prior pivot is solidified by something else, such as maybe there's support, like or there's a flat 200 or a rising 20 period moving average. So if it's solidified by something else, then one reference point is enough. Another time is when the prior area is a place where the prior reference point is an area where there was a major failure or maybe a guerrilla tactic or a gap failure or a breakdown failure, something really interesting happened. Then you can say, well, I don't have two pivots, I don't have a double bottom, I just have one pivot, but that's enough because that pivot is was really significant. Does that make sense? Then one reference point would be enough. So I gave you 4 times when one reference point is enough. Otherwise, you want a double bottom already before playing it long. So the first rally, second rally, and third time, and every other time after that you can do it. Okay, positive memory, that's major support. When the stock comes back down, notice the spike in volume, had a professional gap up here, so that was okay to do. This is the daily chart. This is even a better chart because we had a severe sell-off, right, and a big rally, and the stock here fell really hard to that same area. Who wouldn't want to get rewarded again? It rallied from $21 to $27 and then back down to 21. So positive memory caused by many traders being handsomely rewarded. Rewarded traders always look to repeat their actions. Okay? At top number 1, many people who bought got hurt and now wait to get their money back. At top 2, the buyers who held on get their money back and immediately look to sell. But the group of sellers at top number 2 dramatically increases, making it a great opportunity for potential short play. Why does it increase up here? Due to the other groups of traders that we talked about. The professionals who recognize what's happening, the ones that always short double tops because they're trying to be smarter than everybody else, they're trying to pick the top. So that's selling. Shorting is the same as selling. It adds fuel to the fire, it puts pressure on the stock, and it drops. So it works. It becomes like a regular support or resistance area. And that's why we say major support, major resistance are self-fulfilling prophecies. The stock had a rally from $13 to $19.50 nonstop. Notice the pullback was pretty deep. $2 broke the 20. The 20 was no longer uptrending. No longer pointing up. So when it broke out here, it failed. So this can be considered major resistance because it pulled back 10%. That's a deep pullback. The 20 MA was flat. A flat 20 MA and a breakout usually results in failure. And then you can see, because this was a momentum move, when it breaks, it also collapses. That's why these biotech stocks and the high momentum stocks are great to get if you can catch them. But once they top out, you better run. Because when they top out, they usually give it all back. And sometimes even some more. They give back even more. And then these are just more examples that I've collected over the years. The initial rally, and then the drop. Traders who got hurt look to get their money back. They get their money back, causes another drop. So that's major resistance. Major resistance also. Major support here, but I like the resistance more. Why? Because we had a multi-bar rally with wide range bars towards the top, which is indicative that the stock is perhaps running out of demand. And we got 2 narrow range bars with a COG bar also. So that's major resistance. Origin of pain, area of pain is revisited. Major support, origin of whatever, the opposite of pain, happiness, because the traders got rewarded. Rewarded traders look to repeat their actions. Does that make sense, guys? Does that make sense? Any questions? Let me know. If not, I hope you enjoyed today's lesson. If you have any questions, reach out to our customer service team. We'd be happy to help you. We do these free lessons as a way to share with you what we cover and the level of knowledge and education that our room members are exposed to on a daily basis. We hope that you join us in the Strategic Day Trader room. And if you are new, have never subscribed before, you can actually get the room for 30 days for only 49 bucks. It's basically free. I don't like to use the word free because I don't want you to contact T3 and say and tell them, "Oh, Sammy said it's free." I just mean it's almost free. It's almost free. Now, I don't like to talk about the brag about the room and say it's the best, biggest, baddest room in the world. I just like to say to point to facts. The Strategic Day Trader Room won the award as the best trading room 2 years in a row by Trader Planet. Check it out. I encourage you to check it out for 30 days for just 49 bucks. And then once you're in it, once you check it out, then I challenge you to find a better trading room. I challenge you to find a better trading room. Again, I hope you enjoyed today's lesson. It was a very important lesson on how to locate support because locating support is important when looking to play long. Locating resistance is important when looking to play short. Not only that, but it's also when you're going counter trend, it's an area to look for targets, resistance, support. When you're shorting, that's a target area usually. So I don't think you can be a successful technician without knowing how to find support and resistance on charts. So with that said, I'm going to go ahead and end today's session. I hope again you enjoyed the lesson and I will talk to you next week. Take care everybody and have a good night.